about using domestic law versus tax treaty. Okay. So far we look at characterization. Is it rental, royalty, and so on. Now we're looking at domestic versus treaty. Okay. Now if you look at management fee, okay, Section 12(7)(c) deems management fee to have a source in Singapore. Okay. So as long as the Singapore company is making a payment, which is a management fee, then it's considered a source in Singapore. And by virtue of Section 45A, withholding tax applies on management fee. Okay. But then we have a rule which effect from 29 December 2009, where if you make a management fee payment to a non-resident and the work is done outside Singapore and the non-resident has no presence here, that means not incorporated here, does not carry on a business in Singapore. So if all these conditions are met, then when you make the payment to the non-resident, there is no withholding tax. Okay, so the key point here is services rendered outside Singapore by a person outside Singapore. Okay. Now, because of this exemption, when you are faced with situations where you are paying to your head office or to your related company in respect of services rendered outside Singapore, you don't really need to look at the tax treaty because it's automatically exempted. Okay, so treaty exemption is not really required. Okay, because when you go under treaty, you still have to do your filing. You still have to file IR37. You have to get a certificate of residence and all this. Okay, but once it's exempted, you don't even have to do the filing. Okay. Now, management fee, the tax rate is the corporate tax rate. Okay, or the rate which prevails under the tax treaty. So if you look at, and I've given an example of Singapore-Malaysia tax treaty, where there is a clause for technical services, and it says that the definition of technical services is defined as in consideration for any services of a technical, managerial, or consultancy in nature. Because they use the word managerial, okay, management services are included in that definition, and therefore, if you're making a payment to a Malaysian company for management services rendered, you can use the treaty to apply a 5% rate. Okay. Then the question is, when would I use the treaty? I would only use the treaty if services are rendered in Singapore. Because once it's outside Singapore, it's exempted from tax. But services rendered in Singapore, the withholding tax rate is 17%. So then I would want to use the treaty to reduce from 17 to 5%. Okay. Now then again, not all our treaties have technical services clause. Okay. Like I mentioned, in the morning, we have the OECD model treaties, we have the UN model treaties, and so on. Okay. Our tax treaties with OECD countries generally, or treaties that follow the OECD model, will not have the technical services clause. Okay. The Europeans are actually against this particular clause, so you won't find it. Okay. But treaties which follow the UN model, which are most of the treaties that we assign with Asian countries, tend to have the technical fees clause. So it's present in the Singapore-Malaysia treaty, it's present in Singapore-India treaty, for example. Okay. Now, if the treaty does not specify, if there's no such clause, okay, then there are other provisions in the treaty that we apply to see whether an exemption is possible. Okay. So, just to briefly mention, under the tax treaty, okay, there is a particular clause which talks about profits, business profits. Okay. So, in summary, what the clause says is that if the non-resident derives business profits from Singapore and the non-resident does not have a permanent establishment in Singapore, then that business profit is exempted from tax. Okay. So therefore, if in the treaty there is no such a clause, then we apply the business profits clause, because management fees is business profits. Okay. And then we say, if the foreign company does not have a permanent establishment in Singapore, and permanent establishment is defined under the tax treaty, okay, does not have a P in Singapore, then management fee is exempted from tax, although services are rendered in Singapore. Okay, so in such situations, although services are rendered in Singapore, you can still apply treaty to exempt from tax. Okay, so exemption applies or reduced rate applies. Second, it must be routine support services. Okay, there is a listing of that's available. Okay, what are routine support services? Then there's a third, is that there should be no disallowable expenses which are deducted against that management fee. So once these three conditions are met, okay, we can apply the concession. And how does the concession work? It's something like this. Okay, so say your related company charges management fee of $105. They incur deductible expenses of 100. So the net income to the non-resident is only $5. We apply the 17% tax rate on the $5 to arrive at 0.85, and then we work out the effective tax rate. So we take 0.85 divided by 105 to get the effective tax rate of 0.81. Okay, so this is a rate. 0.81 is a rate which you will fill in the form IR37. Because IR37, you have to declare how much you have paid and what is the tax rate you are using. So you work it this way and then apply that. Okay. So now, when I make a comparison, right? Okay. Say for example, you're making a payment to your Malaysian head office. Okay. You have many options, you know. Services rendered outside, you don't have to apply tax treaty, exempted. Services rendered in Singapore, you can look at the tax treaty, 5% tax rate. Okay. Or you can apply concession. Okay, and the tax rate is much lower than 5%. Okay, so if this works out, if you do the computation, if this works out to be much lower, because the effective tax rate really depends on deductible expenses. Okay, if you have very little deductible expenses, then of course your effective tax rate will be higher. Okay, so after you work this out, you look at the effective tax rate, compare with the treaty, which is 5%. If this is better, then you apply the concession. You don't have to actually use the treaty. But after you work this out, if your effective withholding tax rate, say 6%, then you'll use treaty. So again, you know, such comparison and computations are important to work out which route are you going to. Okay. And another point to note is that for management fees, what Inland Revenue has said is that even if services are rendered in Singapore, okay, but if you are paying on a cost reimbursement basis, okay, that means no profit, okay, then that is not subject to withholding tax. No withholding tax on that. Okay, so therefore there are several issues to consider, right? In a management fee, first you need to consider: should I split the contract? Because if it's a mix, you don't want to determine how much is outside Singapore and how much services in Singapore. So you need a split contract. Those which are work done outside Singapore, no withholding tax, you can set that aside. Then you look at services rendered in Singapore. Then you have a few decisions to make. Okay, do I look at treaty? Okay, or do I apply the domestic concession? Okay, then you look at whether is it on a reimbursement or is there a profit. Okay, because services rendered in Singapore, if you can go on a reimbursement basis, there's no withholding tax as well. Okay, so companies can then make decisions. Okay, should I do it on reimbursement? Should I do it on a with a profit element, on a cost plus basis? Again, that ties to transfer pricing. Okay, are you able to do it on a reimbursement basis from a transfer pricing perspective, from Malaysian transfer pricing rules? Okay, so all these are some of the decisions, factors that can be considered from a withholding tax planning perspective. Okay, and it's kind of worthwhile doing for management fees. Why I selected management fees? Because it's within the group. So if you can reduce withholding tax, sometimes it kind of helps the group as a whole. Okay. Okay, very quickly, when we look at PE, planning from a PE perspective, okay, as I mentioned, tax treaties can exempt certain types of income from withholding tax if they're considered as business profits and a non-resident has no PE in Singapore. Okay. So whenever we look at that particular condition, the PE condition becomes important. Because in order to exempt that income from tax, it must be business profit. Secondly, there must be no PE in Singapore. So that opens up a little bit of planning as well. Okay, so there are different types of PE under tax treaties. So if you look at construction, for example, okay, some treaties will say if the construction lasts for more than 6 months, then there's a PE. Okay. For services, like the Singapore-Indonesia treaty says, if services are furnished for more than 90 days, that's a PE. Singapore-India treaty says services furnished for more than 30 days, that's a PE. Okay. So therefore, all these, construction PE and service PE are based on time, based on number of days. Agency PE is based on what is the authority of the agent. Does the agent have the authority to conclude contracts? If yes, that could result in a PE. Right? Now, when looking at all this, the planning opportunity comes from arranging the transaction in such a way that there might not be a PE. Okay? So if your related company needs to undertake a project in Singapore, if you know that under the treaty, if it's not more than 6 months, there's no PE, can you manage the project so as not to exceed 6 months? If you need someone from Indonesia to provide services in Singapore from a related company, for example, can you arrange it in such a way that it does not exceed more than 90 days? So that's a planning perspective, okay, to kind of manage PE, ensure there's no PE, and if there's no PE, you can go for exemption, tax exemption, okay. So in a nutshell, okay, now we don't have time to cover the non-resident part, so I'm going to skip, and I just want to leave you with just a couple of pointers on compliance, okay. So just some suggestions. Internal audit trail is important. Okay, you can look at each of the contracts that you have with non-residents, tabulate it in terms of timing of payment, nature of payment, whether treaty rates apply, whether tax exemption apply, and so on. Once you come up with this master template, you find that it's very much easier to manage withholding tax compliance because everything is automated. You know exactly when the payments are going to be made and what is the requirements. Okay, and it's important to keep proper documentation in case of IRS audits. Okay, keep all records of withholding tax payments and receipts that you receive from IRS. Sometimes Inland Revenue forgets to send you a receipt. Okay, please ask them to send you. Okay, if you call them, they will. So keep track of all those documentation. Okay. Finally, there are several questions here. I'm not going to answer the questions. I'm just leaving it here for you to take a look. In withholding tax, there are a lot of complexities, a lot of questions arise. Okay, even during the break, a lot of them were asking me a lot of different types of questions. Okay, what we try to do as far as the withholding tax and treaties online product, we try to answer some of these questions in there in various forms. Okay, so I just wanted to leave you with this, and thank you very much for your participation today. It's a real pleasure. Thank you.
Thank you very much.